The International Banking System, History, Risks, and Future Models. 1. Origins of banking. Banking was born out of chaos, not convenience. In the 11th century, Italian markets were bustling, but merchants had a serious headache: too many coins. In Pisa alone, 7 currencies circulated, making trade an exhausting exercise in money swapping. That's where the banco, literally a bench, came into play. Merchants exchanged coins on these benches, and eventually, the bench became the bank. But the real innovation wasn't just exchanging coins. Brokers started issuing credit. Genoese merchants pioneered cashless payments. By the late medieval era, banking networks extended credit not only to traders, but even to churches and kings. In short, banking became the grease that kept Europe's wheels turning. Footnote: banking began as a way to simplify trade in a chaotic currency environment. 2. The business model of modern banks. Fast forward to today, and banks remain in the business of managing risk. Here's the simple version. Savers deposit money and get a tiny bit of interest. Banks lend that same money at higher interest rates. They pocket the spread, knowing some borrowers will default. Risk is part of the game, but without it, economies stall. So what does that actually mean? It means banks recycle unused funds into mortgages, business loans, and credit that fuel growth. Banks also make money in other ways: credit cards, trading currencies, cash management, custodial services. Essentially, they make a living by being middlemen of money. Footnote: banks earn by balancing the risks of lending with the rewards of interest spreads and services. 3. The problem of short-termism. Here's where things got messy. Many banks abandoned long-term stability for quick wins. They dove into complex financial products no one really understood. At their worst, they weren't banks anymore, they were casinos. The 2008 crash was the inevitable result. Risky mortgage lending blew up. Stock prices collapsed. Trillions vanished. Millions lost jobs and savings. Governments rushed in with bailouts, buying toxic assets to keep banks afloat. New rules followed: mandatory capital buffers, stress tests, and other guardrails. Yet, the banking lobby blocked some of the toughest reforms. The result: safer than before, but still vulnerable. Footnote: the 2008 financial crisis exposed how reckless short-term banking strategies can devastate societies. 4. Alternatives to traditional banks. People noticed. And alternatives grew fast. Investment banks now charge fixed fees instead of commissions, aligning with client interests instead of chasing sales. Credit unions, born in the 19th century to resist loan sharks, offer similar services as banks but with a cooperative twist. Members elect their boards, share profits, and often take fewer risks. This member-first approach helped them survive 2008 better than traditional banks. Crowdfunding also changed the game. Platforms like Kickstarter allow small investors to pool money into businesses or products. Risk is spread thin, and backers feel part of something bigger. And then there's microcredit, tiny loans in developing nations that empower entrepreneurs who were once locked out of finance altogether. What started as small-scale charity is now a multi-billion-dollar industry. Footnote: alternatives such as credit unions, crowdfunding, and microfinance provide more community-focused or innovative financing options. 5. The future of banking. The role of banking is not optional, it is essential. Money must move from savers to users, or economies grind to a halt. But how we do this is up for grabs. Will it be through traditional banks still fighting for profits? Through credit unions and cooperatives focused on shared value? Through online platforms that bypass banks entirely? One thing is clear: banking is too important to be left only to bankers. Footnote: the future of banking depends on whether society favors profit-driven institutions or community-centered models.